Chapter 1 is about the introduction to managerial finance. And in this course, it's really a decision-making kind of a course. So in the first couple of chapters, we're going to talk about the environment itself, right? So a little bit about markets, a little bit about some decision-making concepts. So what is finance, right? So essentially, finance can be defined as an art and science of managing money. The art part really talks about soft skills of management. But the science part are the technical skills. It's the research. It's the analysis that goes on. So finance has several different faces, if you will. At the personal level, obviously we're looking at individuals' decisions, but we're going to talk about how much of their earnings people might spend, how much they save, how they invest their savings. And from the business perspective, we really have the same kinds of questions, if you will, right? How does a company raise money, right? Where do they get this money? How do they invest that money to earn a profit? And in the end, how do they decide whether to reinvest profits or pay that money back to their investors? So that is the impetus or the process, if you will, of going through understanding managerial finance or business finance. So managerial finance is about working with a company. How do you run a business? We're going to discuss several different concepts or several different tasks, if you will. We're going to talk about investing. We'll talk about investing in securities. We'll talk about other kinds of companies that you can buy and invest in them through mergers and acquisitions. We can talk about investing in operating assets. This is what's referred to as capital budgeting. We'll discuss a little bit about financing, long-term and short-term. And of course, this all is rolled up in this broad concept of strategic planning and implementing that plan for the company. So what is a company? It's an entity that sells goods or services. And the form of business is dependent on several factors, right? But the basic forms, there are really three basic forms. Sole proprietorships, owned by one person. Partnerships could be owned by two or more people and obviously operated for profit, or they're working towards profits. There's a couple of different types of that, either general or limited partnerships. And then there's a corporation. It's an entity that's created by law, right? They have legal powers of an individual, right? They can basically do almost anything that you and I can do except for vote. And of course, they could be private or public. There are other forms, subchapter S's, LLC, LLP. These are just hybrids of the above companies or the above types of forms, if you will. So if you look about these forms and how prevalent they are in our economy, as I can say, there's 5 times more sole proprietorships than corporations. There's 6 times more revenue comes from corporations than comes from sole proprietorships. So obviously, number-wise, there's a lot of sole proprietorships. There are lots of entrepreneurs in our society. However, they don't create the bulk of the revenue that comes into the economy. So again, we need to kind of understand, kind of apply this to the tax code, right? If you want to increase the amount of business that we do, right, we need to look at who creates the greatest amount of revenue and how that could increase with some type of tax change. So there are several factors that we associate with choosing this type of form. Taxation. Sole proprietors and partnerships pay individual taxes. corporations pay taxes, but their owners also pay taxes. This is what's referred to as double taxation. The risk is important, right? If a business is sued, where will they find the assets to pay for the losses, right? So we need to understand, what is the definition of business assets? For a sole proprietorship and a partnership, the business assets are not just the assets of the company, but they're also the personal assets of the owners. So all of those assets are at risk. So depending on what kind of form of business you choose, your personal assets could become subject to loss because of being sued. Cash, right? How do companies, where do they go to get their cash? Essentially, we know it's difficult for lots of businesses to raise cash, but it's particularly difficult for small businesses like partnerships and sole proprietorships to raise cash. And in the end, who controls the company, right? Who runs the company itself? Why would you want more owners? If you started out as a sole proprietor, why would you want more people to be involved in running the business and owning part of that business? It could just be you need more cash. But on the other hand, you may also be looking for somebody with some complementary skills, right? If you're very good at being a carpenter, you probably don't have a lot of really good skills at running a business or marketing the business. So maybe you want to find somebody that knows a little bit about carpentry and a lot more about marketing, etc. So choosing the form of business depends on how you want to be treated with respect to these four categories or factors, if you will. So if we look at business taxation, right? Obviously, individuals and businesses have to pay taxes. Sole proprietorships and partnerships are taxed at the individual owner level. So there's basically two kinds of taxes, if you will. There's ordinary income and there's capital gains income. Under current law, the tax treatment of ordinary income and capital gains tax changes frequently due to changes in the tax code. Currently, long-term capital gains are taxed at a lower rate than ordinary income. Now, with some recent changes, that's become there's a lot smaller gap between those two tax rates. So let's talk about this concept of something called double taxation. This is where the owners pay taxes on dividend income, but since they also own the corporation and the corporation pays taxes, they actually pay taxes twice. Now, corporations themselves get a tax break, if you will, on dividend income. They only pay taxes on 30% of the dividend income they receive. So this sounds like a good deal for them, but again, because of double taxation, if they paid the full tax on dividends, that would essentially create triple taxation. There are two tax rates that we need to be concerned about. The average tax rate is the average paid per dollar earned. It's not really a good number for decision making, but it's the tax liability, the tax that you owe, divided by taxable income. Now, the marginal tax rate is the tax that you pay on the next dollar that you earn. Now, this is the most important tax when we're talking about making decisions, because you want to think about what will the tax be if I increase my profits in the future? What will the additional burden of tax be? So for a single taxpayer, again, remembering that in the tax codes have changed a little bit, so we have to worry about how things are going to change. This is the 2018 tax rate for single taxpayers. John here earns $90,000 from his business as a sole proprietor. He has no other income. So what is the tax and what are the tax rates? Well, to find the tax, you find the income. $90,000 is in this row. And the formula is $14,090 plus 24% of any amount over $82,500. So if you do that math, you'll find out that the tax owed is roughly $15,890. Now, what is the average tax? You take $15,890 divided by this 90,000, and you ultimately end up with an average tax rate of 17.6%. But what if John wanted to do another business, say, or take on another contract, and this contract was going to increase his income by $10,000? What tax would he then pay on that extra money? It's not the average tax rate. The actual tax he'd pay on another $10,000, since we'd still be on this row, any additional tax is taxed at 24%. So the marginal tax rate, that's this number in this column right here. These are the dollars that you pay for each dollar that's on this line. That's the marginal tax rate. But what if this was a corporation? Again, let's assume that he has no other income. It's a private corporation, if you will. And he has no other income. This is his entire income. What would happen to his tax burden? Well, remember again, these tax codes have changed recently, but how you calculate this again, you find the $90,000, it's on this line. It's $13,750 plus 34% over $75,000. That's $18,850. The marginal tax rate on that row is 34%. Individually back there we saw it was 24%. And the average tax rate, that's the $18,850 divided by 90,000, is 20.9%. Now in this example you can see that the difference between the average tax rate and the marginal tax rate is substantial. So you want to use the right tax rate when you're thinking about making some kind of an investment decision. Now if John received all $90,000 of this as dividend income, now he wouldn't, but if he paid out all $90,000 as dividends, he would also pay an additional 15% tax. 15% of 90,000 is another $13,500. So his after-tax rate, or his average tax rate would be that $13,500 plus the $18,850 that was paid by the corporation. Divide that by 90,000, and now his average tax rate is 36%. So the idea here, or the illustration hopefully, is that corporations themselves don't necessarily pay higher taxes, but the owners of corporations pay substantially higher taxes because they have double taxation. So how does finance relate to other disciplines? It is a spin-off of economics. Economics is a little bit more academic and theoretical in nature, and finance is a little bit more of a practical orientation. So we will talk a little bit about some economic concepts, but quite frankly, if you can understand a little bit about marginal benefits, and if you understand a little bit about supply and demand of assets, then you understand most of the decision-making theories that we're going to talk about in this course. Accounting, on the other hand, is a little bit different, right? Accounting involves the process of recording economic transactions and according to some set of rules, if you will. They then prepare statements for publication and obviously internal use. Now, finance is concerned with the control and analysis of cash flow. Cash is the asset that financial managers use to measure, to make decisions. So accounting is a reporting function, and finance is the applications function, if you will. So the other disciplines are directly related. However, they do have some differences in decisions and how they ultimately are used. So one of the questions we have as we think about decision making is, what is the goal of the firm? There are two primary benchmarks, if you will, and quite frankly, I prefer the word benchmark to goal, right? But there is a benchmark that we typically use to make decisions about the company. And there are only really two choices: maximizing profit or maximizing wealth. So let's kind of talk about those two topics. So let's start with maximizing shareholder wealth. This is the primary goal of managers and what they should use to maximize the wealth of firms' owners. Essentially, what this means is maximizing shareholder wealth means we should try to find ways to make the stock price go up. When you think about maximizing profit, a question we have is, does profit maximization necessarily lead to the highest possible share price? And for at least three reasons, that answer is often no. The timing of cash flows is important. That's not considered in profit maximization. The cash flows that are received, profit is an accounting tool, a line item. It's not cash. And finally, in the end, it really doesn't look at risk. It doesn't assess the riskiness of the cash flows that we're talking about. So when we think about making financial decisions and you want to use a variable, and let me take a step back just for a second. I am not saying that profits are bad. What I'm saying is when you make a financial decision, the variable you use in your analysis should not be profit, it should be shareholder wealth. Because maximizing shareholder wealth, it considers cash flows, it looks at timing, it looks at risk, but in a very basic concept. This is why people buy stock. People buy stock so they can increase their wealth. If you can't increase shareholder wealth, shareholders will either fire you and find somebody that will, or they will sell their investment and go elsewhere. This is what the owners of the company actually want. And we have a very simple formula here where the share price is essentially the future dividends, these are cash flows, right? Divided by required return. And this basic concept here basically says that the value of share prices, the value of any asset, quite frankly, is related to the level and timing of cash flows, and it's also related to the riskiness of cash flows. So as we go through this course, from here on out, this concept will be in every single chapter, every single technique that we talk about. We want to address shareholder wealth. Should we do anything for the company? The answer will always be only if we can increase the wealth of shareholders.